All right, let's talk about a technical indicator that's kind of legendary in the crypto world. We're talking about a signal that has this wild reputation for calling the absolute peak of Bitcoin's craziest bull runs, sometimes with just days to spare. It's called the pi cycle, and trust me, it's one of the most fascinating and controversial tools out there.
But you gotta ask, right? Can a simple math equation really predict something as wild and chaotic as a crypto market crash? Can two lines crossing on a chart actually warn you before everything tumbles? Well, the history on this one is surprisingly compelling.
I mean, historically, this thing has nailed major market tops with just stunning precision. A track record like that, you kind of have to pay attention. So the real question is it just a lucky fluke, or is this thing a genuine crystal ball for Bitcoin? Let's dig in. So what we're looking at is the pi cycle top indicator. It was developed by Philip Swift back in 2019, and he designed it for one very, very specific job: to pinpoint that exact moment when a Bitcoin rally gets way too hot, becomes unsustainable, and is about to turn around hard.
And seriously, that's not an exaggeration. The data is pretty clear. Its performance in the past has been almost prophetic, calling the top with just a couple of days to spare. So how on earth does this supposed crystal ball actually work? What's the magic behind it?
Well, let's crack the code. It sounds super complex, I know, but it really just boils down to how two simple moving averages play off each other. It's not magic, it's just math.
At its heart, the pi cycle is trying to tell us when the short-term hype has gotten way ahead of the long-term stable trend. You can think of it like a fever thermometer for the market. It's a signal that things are getting dangerously overheated.
And the ingredients here are surprisingly simple. You've basically got two key parts. On one side, you have the accelerator. That's the 11-day moving average. It captures all that recent, fast, sometimes frantic price momentum. On the other side, you have the baseline, the 350-day average, but multiplied by 2. This represents the steady, long-term trend. The big signal happens when that fast-moving accelerator finally crosses above this slow and steady baseline.
And you might be wondering, why pi? Well, it's a pretty cool little detail. If you actually divide 350 by 111, you get something really close to 3.14. Pi. It's a nice mathematical touch for sure, but the real power isn't the name. It's how these specific timeframes have historically lined up perfectly with Bitcoin's market cycles.
The bottom line is, this isn't based on somebody's gut feeling. The calculation is dead simple. When the 11-day average physically crosses above the multiplied 350-day average on a chart, boom, the alarm bell rings. It's a purely objective event.
And it's an objective event with a pretty mind-blowing track record. So let's look at the 3 times this signal is actually flashed in Bitcoin's history and see what happened right after.
Okay, check out these dates: 2013, 2017, and 2021. In each of these years, the pi cycle indicator fired off its warning shot right at the peak of a massive bull run, and every single time, a major market crash followed.
Let's start with 2013. The signal flashed. Just 4 days later, the market topped out, and then a 65% crash.
Then came 2017. This was the big one. It called the top just 3 days before that epic 84% collapse that started the big crypto winter. I mean, the timing was just uncanny. And then again, in 2021, it was like history rhyming. The signal went off just 2 days before another major top. So 3 signals, 3 massive market peaks called. For a while there, the pattern was just undeniable. So with a track record like that, you'd think the moment this thing flashes, you just hit the giant red sell everything button, right? Well, not so fast. That's actually not how experienced traders tend to use it. It's much more of a strategic tool than a simple panic button.
So what's the actual playbook? Well, first, the signal is a warning, not a command. Smart money might use it to start reducing their exposure, maybe selling off a portion of their holdings. They also look for confirmation from other tools, like the RSI or the Fear and Greed Index. And most importantly, they use it to prepare their exit strategy, setting up stop losses to protect their profits. It's all about managing risk, not panic selling.
But, and this is a big but, here's the billion-dollar question for today. The indicator's perfect track record was built in a totally different market. Now that Bitcoin is entering a whole new era, we have to ask, has the magic faded? The market today is fundamentally different. That forces us to really consider, is a tool that was built for Bitcoin's past still a reliable map for where it's going in the future? And this slide right here really gets to the heart of the debate. The pi cycle worked like a charm in a market that was driven by these predictable 4-year cycles of retail speculation and mania. But look at the market now. It's becoming more and more dominated by huge institutional demand, especially from the spot ETFs. This isn't just retail hype anymore. It's consistent structural buying pressure that could completely break those old patterns the indicator was designed to catch.
And we also have to be really honest about its weaknesses. It can throw false signals in choppy markets. Its entire reputation is built on just 3 successful calls. Is that actually statistically significant or just a really lucky coincidence? It's also a lagging indicator. It confirms a top is likely in, it doesn't predict one is coming. And finally, it was made for Bitcoin and only Bitcoin. It just doesn't work on other assets like Ethereum.
So, where does that leave us? What's the final verdict? Honestly, the best way to think of the pi cycle indicator is as that market fever thermometer we talked about. It is an exceptionally good tool for telling you when the market is absolutely euphoric and overheated. But it's not a crystal ball. It's a valuable piece of the puzzle, but it is not an infallible oracle.
Which leaves us with this final critical question. As these massive institutions and brand new financial products completely rewrite the rules of the game, is the elegant rhythm of the pi cycle going to be a timeless pattern, or will we all look back on it as a fascinating but ultimately closed chapter of Bitcoin's early history?